Hey guys, we are back again with another learning video. Today we are going to do a topic which most of the students find very difficult. But if you understand this topic conceptually, then it's not that difficult at all. We are going to learn about deferred tax today. What is deferred tax? Most of the students get confused in how to deal with deferred tax in an exam scenario. We need to understand deferred tax conceptually rather than rote learning the definitions that are given in the book. You need to first understand that in IFRS, deferred tax has a balance sheet approach which is followed. It is not a P&L approach that is followed in IFRS. Now, what do I mean by balance sheet approach? Balance sheet approach means if there is a difference in the amount of an asset between the accounting balance and the balance of that same asset or liability in taxation books, then it gives rise to temporary difference. Why there are two separate books which are being made? When I say there is an accounting book and there is a taxation book, what do I mean by that? Accounting books are prepared based on the IFRS that are mandated. Taxation books does not follow IFRS necessarily. The rules for taxation are different. Let's take a hypothetical example of a car. If you purchase a car for your company purpose, the depreciation on that car is based on the useful life. This is what is suggested by IFRS. Now, IFRS doesn't specify what is the useful life that you should take for a car. IFRS suggests that the useful life should be taken based on the estimate by the management. That is, the company needs to decide what should be the useful life of this car. So, let's assume that you are depreciating your car in 5 years' time. In your accounting books, you will depreciate this car in 5 years' time. Let's take an example that you have taken a car which is for $10,000. To simplify it, by 5 years depreciation, you will depreciate this by $2,000 every year. So every year in your accounting P&L, there will be an expense towards depreciation of $2,000. Now let's go back to taxation books. In taxation, tax authorities are not concerned of how many years you are going to use this car. Tax authorities will specify that for any users, be it a company or a person who has bought a car, they can claim depreciation only for 4 years. Now you see what has happened. In your taxation books, you will be claiming a depreciation of $2,500. But in your accounting books, you are claiming depreciation of only $2,000. What happens to the balance of your asset between accounting and taxation is, at the end of the year, you will have a written down value in your accounting books of $8,000, whereas for the same car, in your taxation books, you'll have a balance of $7,500. The difference between this $8,000 and $7,500 is called as temporary difference. On this temporary difference, you need to create a deferred tax. How this deferred tax should be recorded, whether it should be recorded as a deferred tax asset or a deferred tax liability, that depends on, you need to ask yourself a question. Are you paying higher tax right now or are you paying lower tax right now? You always pay tax as per your tax rules. You never pay tax on the profit as per your accounting rules. You need to adjust your income and expenses as per tax rules and then arrive at the net profit figure. And on that, you pay the tax. In our example, what has happened is, in your tax rules, you are claiming a higher expense because you are claiming $2,500 as an expense. Whereas in your accounting rules, you are only claiming $2,000. Because of this difference, the net profit is also lower in your taxation books. Because the net profit is lower, you are paying lower tax. That's why I said you need to ask yourself a question. Are you paying higher tax right now or a lower tax right now? Because you are paying lower tax right now, you need to create a liability for this temporary difference that we just arrived at. How do you arrive at the deferred tax amount? The temporary difference needs to be multiplied by the enacted tax rate that is applicable for your company. So in our example, let's assume 30% is the tax rate. So you'll create a deferred tax liability of 500 multiplied by 30%, that is 150 will be your deferred tax liability. This should go as a charge to your P&L and you will create a subsequent liability for the same amount. This is a scenario when a deferred tax liability is created. Vice versa, you do it for deferred tax asset if the useful life in accounting was 4 years, whereas in taxation was 5 years, then your temporary difference gets reversed and you will be paying higher tax right now, for which you will get a deduction in future. In that case, you would have created a deferred tax asset. I hope this simplifies the concept of deferred tax for you. Please let me know in the comment section if you want me to clarify more on this topic, or if you feel any other topic which I should simplify and bring it to you. Please subscribe to our channel and happy learning. Thank you.